All right. Uh, so hi everyone. This session is going to be about some practical insights into one of the case solutions that my team did some time back. And I know that you've had sessions on what case competitions are and a bunch of other things related to that. So this session is not going to be about the basics of case competitions, but it is going to be more about how to structure a solution and come up with a solution deck. So hopefully you're excited and let's begin. So a bit about myself before we dive into the solution structure. Um, I come from India and I've majored in uh, business. I have completed my graduation from Delhi University and I've joined Bain out of college where I'm currently working. In college, I was mostly involved with a lot of case competitions, as you can see, and amongst those competitions is global case competition at Harvard, McGill Management International Case Competition, HSBC case competition, and a couple of other competitions as well, which I was mostly involved with. Um, so that was something that kept me busy throughout college, and that was something I enjoyed doing along with my teammates. Um, Coming to internships and organizations, I've been associated with Goldman Sachs in the past and EY, where I interned in my first year. Um, I'm also part of this chapter called Case Connect Club, which is basically an international network of case solvers who who get membership and access to different resources and guidance from people across the world who are in the industry, as well as people who are pursuing higher education. And it's a good network of like-minded people who come together and either conduct academic sessions or share good resources. So it's definitely something you should look to be a part of if you're a budding case solver. And that is something I've been associated with recently. Now, coming to interests, I think you can see that for yourself. I'm not going to go into that a lot, but this slide is going to serve as a reference for the kind of work I do at Bain, and I'm going to go into that in the next slide. Now, kind of work we do at Bain, especially the private equity practice, which I'm a part of, is essentially answering different investment questions using some diligence tools. So the way a private equity transaction is laid out is it has a pre-investment stage wherein you're looking at companies um, to invest in from the PE firm's perspective. Then you're looking at diligences wherein you're conducting a diligence on an existing portfolio company of a private equity fund. And one would be a post-acquisition scenario wherein you want to probably exit, the PE firm wants to probably exit from the situation, and you want to consider whether it's worth exiting or where to exit from there. So those are the three kinds of stages in a PE life cycle, and we have products for each of those stages. Um, in pre-investment, if you see target screening, it is something to do with coming up with a universe of companies in a particular industry and going and filtering down to some relevant set of companies wherein who match your company in terms of business fit, revenue, investors, and a bunch of other metrics. And you feel that these are the companies your company can probably acquire to expand their business. So target screening is more like finding out, scouting for M&A opportunities. Then you have diligences. In diligences, you could have something like digital analytics, where you try to understand what is the company's current website traffic like, how many people visit the website, and how popular is it, and understand those kinds of metrics of the website. And workforce analytics would be something to do with understanding your company and its competitors' workforce metrics like attrition, employee growth, where employees come from, and understanding other metrics related to that. Uh, then we have post acquisition, where we have survey analytics, and that would basically cover surveys rolled out by the firms to concern stakeholders to understand how the company is doing vis-a-vis competitors on different KPCs, what is the net promoter score like, and understanding more questions and trying to come up with the answer and the summary of that question and from the raw data that is given to us by the survey vendor. So survey analytics is mostly answering those questions, and these are the main products we have across 3 stages. Now, the work itself is very fast paced, and and experience and projects change very fast because the PE scene is very quick, and you have multiple cases happening at the same time. So you switch from cases to cases. Sometimes it gets a little hectic, but the good part is that you get to work on a bunch of things at the same time, because the more cases you work on, the more industries you target, the more tools you use, and that just increases your analytical prowess. So industry exposure is there. Business acumen is definitely tested in PEG. Um, we use different tools as well, as you can see. The ones that I've used are Alteryx, SEMrush, SimilarWeb, and these tools are again used for different projects, which I'm not going to right now. As an analyst, what I've been basically doing is understanding or taking ownership of some work streams, understanding how this particular piece of analysis contributes in the final answer, and uh, making sense of the huge data or the huge um, chunk of data that we have, and trying to come up with an answer for that. Because the main focus is, if you can develop an answer around the data, then it's useful for you, and you include that in your analysis. So I think that is the kind of work that happens in private equity. And this is the Center of Excellence, COE, that I am a part of. Um, Now, I think before we move on to the next slide, I would just give you a moment to understand whatever is given on the slide. All right. So this is about the global case competition at Harvard that happened in 2020. And this is the case from 2020 that we had, Amazon and Netflix. You can go through the text that's given here, and I can even tell you what the gist is like. Basically, the case was an M&A case, and we had to decide if Amazon should acquire Netflix, and if not, what should it require to expand its content library. And mind you, this is 2020, when Apple TV, Disney Plus, and all of these services had just come into the picture. So Amazon really was facing competition. And this was, in my opinion, a very aptly timed case when it happened, because that's when OTT really picked up, when COVID started. So this was the kind of case we had. And I can now go into kind of solution structure uh, that was recommended for this, and that we ended up following to an extent, and also like improvising on that. So the solution structure for the whole deck, which was not more than 100 slides, and also the fact that this competition is spread out over a few days. It's not about 10 hours or 12 hours or 24 hours. It's spread out over 2-3 weeks, and it may not be particularly relevant to IOCC, which is, I think, time bound. But it's one of those competitions wherein you get some time and you need to come up with a world-class solution and prepare a proper deck. So from that perspective, uh, this competition is very relevant. What we came up with was an executive summary, which basically highlights the crux of the whole solution, what we are trying to propose and what we are not trying to propose. Then we have an introduction section wherein we basically provide, say, company overviews of both companies that are in question. What are their market positions like? What is the status of those companies currently and where they're headed? And also talking about the industry. In this case, the industry is OTT, and giving a breakup of the industry growth and the opportunities that are coming up in the industry. So that was our first section. Then we came up with financial due diligence, um, which is basically valuing or conducting a proper valuation using discounted cash flow as well as a few other metrics. Methods like relative valuation, in which we had precedent transactions and um, the multiple transaction. So we conducted valuation from different methods, and then we sort of understood how is Netflix valued, and would it be a feasible acquisition for Amazon. Then we go to the non-financial due diligence here, which is understanding the strategic fit between the two companies. Would there be any synergies in the two companies? What would be the threats of the transaction? How would they stack up together if the acquisition goes ahead, and so on. And lastly, a conclusion as to what does Amazon need to do if it should go ahead with the transaction. What are the next steps if it is not? Then what are the next steps? And sort of giving a direction to Amazon's future course of action. So these are the main sections under which the solution is broken, and you can obviously tweak with it, modify it, change the sequence if you want. And now I'll be going into the actual solution that we proposed. As you can see, starts off with the slide, the content slide. We have an abbreviations table and an executive summary. So this was our executive summary, and we'll be going into this in detail. We proposed that Amazon should not acquire Netflix, and we instead proposed to target like Viacom CBS for the purposes of expanding its library. Now, we started off with industry analysis in the introduction section, and we broke up the whole entertainment and media industry in three parts, and we come down to ODT. When we come down to ODT, we then map the entire industry, give a breakdown of, okay, which companies fall into which sub-industries within this. And this is not completely necessary, but it just helped us give a breakdown of what are the different players in this industry. Then we developed through our research, we saw the trends in the industry, what's happening in the industry, the growth rates and everything, and how subscription video on demand is basically growing within the entertainment and media industry. So a lot of research went into these slides, come up with those kinds of solutions. Then we came up with okay, now different conglomerates like Disney, Warner Media, Amazon, all of them are trying to come up with their OTT services. So that is a shift in the kind of players that are coming in here. Traditional players are launching OTT services, and also on the left, you can see that subscription video on demand SVODs are highly valued by the capital markets. So they're definitely pricey. That was the kind of intent behind the slide. And here we come across different studios owned by these players and sort of a map to understand, okay, ABC Studios, Fox, Disney, these are the different players and what do they own. Because as you can see over here, Disney has a lot under its belt already, and after this solution was made, Disney definitely acquired even more. So Disney is currently the juggernaut in this space, and we have other players as well. Then we are also seeing a shift in the sense that streaming companies are creating their own content, and the investment in own content, original content, is going up, which is a change that we saw of late. Now we came to the company overview slides, talking a bit about Amazon and then Netflix. I'm not going to go into details here, but basically this would be something like, okay, understanding Amazon, what it does, not just Prime Video, but a bunch of other things. What are its different offerings, and showing its breakdown, growth by offering, and yeah. So this is the cloud computing vertical Amazon has, which is the biggest cash cow, and private labels, which is a future cash cow that we understood. This is Amazon's acquisitions in the past, and it's mostly acquiring companies which it can vertically integrate in its business, or a completely new market, but not much of inorganic expansion that we saw. For example, you have PillPack, which is complementing their already existing e-commerce business, and you have IMDb Love Film, which complements Prime Video through movie ratings and so on. In terms of the S-word market, if you compare Prime Video and Netflix, Netflix was definitely ahead of Prime Video when this solution was made. And in terms of customer satisfaction, in terms of Emmy Awards, um, and so on, like you can see the subscriber bases as well. So Netflix was clearly the leader, and this is an important point to understand the feasibility of the transaction. We look at Netflix and its overview. We look at its size and its breakdown by different regions. Now, a key part of our research was understanding these polls and surveys wherein they ask the subscribers or the people as to what is their sentiment like. So these surveys really help you understand what direction is the company headed, and they give you that confidence in your answer as well. So quoting surveys and good quality surveys, and trying to use that as a direction in your slide is definitely recommended, because they give you some valuable information. Then we have geographical presence again, which is given here, not much to discuss. We have international market expansion given here, and a few callouts. Say, for example, here we have something from the CEO about the future plans. That definitely adds value to the slide. Now, technology definitely forms a major part of Netflix, and we'll be discussing this soon as well. It's into content, it's into distribution as well. It's developed its tech infrastructure in a good way. So in the sense that it's self-reliant in a lot of ways. And this will again play a role in the synergies that can accrue with the two companies. So this was some breakdown about the company, and now we understand strategic fit of the two companies. Now in strategic fit, what we're going to do is look at what will happen if we combine the two companies. So over here, you can see that we first looked at the bundling problem, how one of the services is provided in a bundle of Prime Video and the other is completely separate. And the pricing part over here would be difficult because it's not an apples to apples comparison here. So we've looked at that concern of bundling, since in Prime Video is a part of Prime, and Prime includes a lot of other services as well. The subscription services section here. Now, when we go to merging the two companies and understanding, Netflix originals are something which is what a lot of people use Netflix for, and this content is not available anywhere else. So original content is definitely a key point for Netflix. And what's going to happen is that if you merge the two, you need to maintain a reputation of Netflix as an original content creator. So this is just a concern that needs to be taken into account. Now, if you replace Prime Video with Netflix, um, now Prime Video, as I said, comes with a bunch of other things as well, and not just Prime. Prime Amazon Prime comes with other things as well. And it's usually very cheap. Prime Video is not so expensive in most countries, but Netflix subscriptions are a tad expensive. So you need to look at that in the sense that how um, Netflix being included in the bundle might disrupt the entire pricing of the bundle. And usually people want Netflix as a standalone service and not as something that they are getting as one of the parts from the bundle, because that just dilutes the importance of the Netflix membership. So that was one of the consideration we sort of looked at. And now we're going to talk about the technology strategies and the technology synergies. And there are mainly three things that Netflix spends: infrastructure, which is related to the servers and the streaming experience; watch recommendation algorithm, which is, I think, self-explanatory; and content valuation and marketing research, which Netflix does very well. And it basically means Netflix knows what to produce, how to produce it, and when to produce. So those kinds of questions on content. So these are the three places that Netflix spends a lot. And if you look at Netflix algorithm, which is very good, it really tells you which shows you want to watch in a very accurate manner. And it also performs its content research in a very good way. Uh, it really knows what the audiences want to see and how to produce it and how to right. So as I was telling you, when we look at the combined offering of Netflix and Amazon, we need to understand what are they good at, both of them. And we can see that Netflix is definitely good in algorithm and content selection, uh, which is a key factor for their success. And Amazon is good in the tech infrastructure aspect of things because they have Amazon Web Services, which really helps in delivering good quality data through their servers. So now that we've understood what both the companies are good at, we can now understand what would be the synergies, if at all, in the transaction. Now, infrastructure wise, Netflix will save money as they begin to use Amazon infrastructure, because Amazon, as I mentioned, is has a robust offering of Amazon Web Services. Amazon can save on algorithm and content valuation, which Netflix is so good at, because we all know that Amazon would need help on the recommendations algorithm. And in terms of what to produce and how to produce it and when to produce it for what audience, I think Netflix does a phenomenal job, and that can definitely help Amazon if they're both combined. In terms of leasing, we look at what's going to happen to content expenditure. Mostly, if you see content on Netflix or Amazon, is content that was created by another studio and exists on this platform, not as their own original content, but as leased content. So we need to look at that as well. That most of the data, even though there is a push on originals, most of the content on Netflix is licensed content. So that is definitely one thing that needs to be seen, that once they combine, what would the expenditure on licensed content be like? And leasing costs are often, as I've written here, dictated by the presence of other big players. Because if you have bigger players in the market, um, they are going to charge you money for leasing out their content on your platform. If you have a lot of these players, they may charge you lesser. But if it is a monopoly, they'll obviously charge a lot. So that is something that needs to be seen and depends on the industry structure. Now, the synergies that will accrue on leasing is that there is a combined entity of Netflix and Amazon. It would have like a huge reach in terms of subscribers, and a lot of major studios would be willing to lease out their content to this combined entity because of the reach of this platform, right? Now, it would definitely be easier for them to have leased content. It would come out to be cheaper because of economies of scale, and we have calculated in three scenarios: base case, uh, low case, and high case. On the right, we will try to understand the kind of savings that can accrue in Netflix and Amazon. So this is definitely an advantage of a bigger entity, that you get to have a bigger say in the market. You can have reduced leasing expenses as opposed to when you were just one entity in the market. Um, Now we come to content distribution network, and this is a very important part of the synergies, because content distribution would basically mean how data or backend data is relayed from the servers to the end user through a distribution of servers. Um, Now, what Netflix already has is something called Open Connect appliances, OCAs, where in areas of high demand, they have these servers which help deliver data closer to the customer for higher efficiency and quality. Now, this is something that they've already established. And Amazon has CloudFront, which is their content delivery network, which is already established. Now, since a lot of investment has gone into Open Connect appliances, OCA, the synergies would be less because, firstly, a lot of money has gone into this and in Open Connect, and the merger of the two entities would mean that Open Connect is deemed useless, which would be financially very destructive, in the sense that Open Connect cannot be liquidated easily. It's tailor made for Netflix, and there would be not enough buyers to sort of buy it from the merged entity. And once Amazon and Netflix are integrated, there would definitely not be any other player who would need Open Connect at that huge a scale. So Open Connect, the technology that Netflix has already developed, would be deemed redundant, and it would not be financially viable for them to merge on this aspect, because they both have their own developed infrastructures already in place. If Netflix, for example, did not have a robust offering and depended on a third party, then probably we could have had synergies because there was nothing to lose for Netflix. So this is something that we came up with in our research on what Open Connect is, how the companies operate, their business models, what goes on in the backend. All of that research really helped us understand these synergies. Um, and we can also see on the right that CloudFront, which is Amazon's CDN, is a tad expensive as compared to other CDNs available in the market. So even if they do combine, they would not be getting the cheapest option out there. Now we go to financial analysis, and first we talk about relative valuation, which covers comparables. And to understand comparables, you need to first understand the universe of the companies here. So we sort of divided the entire entertainment and media players into OTT, cable satellite companies, and content production companies. And you can see Disney lies in the middle somewhere. Uh, it is technically into all three. With Disney Plus, it entered OTT, and it was already into the other two categories before. And you can see other companies here. Netflix lies on the OTT content productions side of things, and Viacom CBS, as you can see, the target we are about to propose, uh, is mostly a cable satellite player with a touch of content production, and it also was about to come up with CBS All Access, but that was not yet launched. So that's why we've not counted that into OTT when we made the deck. On the right, we have a category of FANG stocks, and I'm sure you would be aware of what FANG stocks are. Um, Now, understanding these different segments and how relevant they are to the comparables universe was based on these revenue drivers and cost drivers. And we finally selected a couple of buckets. We retained content production companies as relevant, OTT companies, and we also retained the FANG stocks because of the fact that something like a Netflix does require comparison with its peers in the FANG stock because these are technology stocks and these are the biggest technology stocks in the world. So we've just retained that as another bucket for comparables. And then we understood the different multiples, EBITDA margins, EBIT margins, net income margins, try to understand where Netflix lies as compared to its peers, based on other criteria as well, which you can see on the right. So we get a sense that Netflix is, when we look at the five closest comparables, it has similar margins in EBITDA, EBIT, and net income. When we look at trading multiples, we can see that Netflix is overvalued in terms of the trading multiples we have seen. And the next 12 months, multiples were a little conservative because of COVID and the onset of uncertainty that accompanied with it. So yeah, we have trading multiples comparison as well with the five closest peers. Then we have precedent transactions, and precedent transaction would basically mean going through the different M&A transactions that have happened in this industry in the past and understanding what multiple they were executed at. So we're looking at two multiples here, EV by EBITDA, and on the next slide we have EV by sales. And we try to understand what were the multiple values in different M&A transactions in this industry in the last 10-15 years to sort of arrive at the multiple that is average. The average here comes out to be 12 times. So in layman terms, that would mean a transaction was executed at 12 times the enterprise value of the EBITDA. So for example, when Comcast acquired NBC, they would have done it at an average of 12 times the EBITDA. That is the meaning that's coming out. And similarly, we have EV by revenue as a multiple here, and the average is 3.5x. So once we've understood the averages, we know what's happening in the industry, what's happening in the past transactions, what's happening with the peers, and how they are valued. So this was about comparables. Then we went on to discounted cash flow, which is valuing a company from its intrinsic cash flows and not looking at comparables or any other relative metrics. This was fairly exhaustive in the sense that we had different forecasts, the base case, the optimistic case, and the pessimistic case, to put it that way. And over here, we did a lot of research. We both went through the 10K reports. We went through different valuation takes of Netflix and how it's valued and how people look at its value going forward. Revenue, asset production, asset projections, and this is the kind of free cash flow calculation that we have. I'm not going to go into the detail here since this would get a bit technical, but basically this is using the cash flows of the companies in the future, discounting them through the present, and finding the value of the company intrinsically. We have sensitivity analysis as well. If we vary the perpetual growth rate, what is the share price we get? If we vary the perpetual growth rate, then what is the enterprise value we get on the right? And you can see the waterfall chart. The left chart is going from the market value that Netflix currently has, the share price, and then the intrinsic value of 330, and how you can see the market overvalues it by $38. On the right, you can see how we go from enterprise value to equity value, and that is the kind of valuation we've done using DCF. Now, this is a football field, which basically means understanding all three methods, the multiples I was talking of earlier, the precedents, and the DCF, and seeing what are the lower and upper bounds of valuation for each of those methods, and then arriving at an average share price of $239. So after assigning different weights to all the methods, we arrived at an average share price for Netflix. And this is important since averaging it out makes sure that your valuation is sound. You've taken into account intrinsic as well as relative valuation, and you have basically looked at everything comprehensively and not just from one lens. So that is the kind of share price we get. And that translates to an equity value of 100 billion and an enterprise value of 127 billion. Now we try to understand if we have like an equity value of 105, which is calculated here using the share price into the number of shares outstanding. So we're trying to see if we have this equity value that needs to be bought out. We add the synergies that we calculated earlier. This is the kind of value of the company that would ideally be paid. But now we try to understand what we'll end up paying in the real world. We'll end up paying obviously the whole market cap of Netflix, followed by a premium, and the premium notes we've written why the premiums are high in this industry. And then maybe an additional premium as well, which is something specific to Netflix, since it initiated a poison pill program and it does not allow takeovers so easily. So in essence, you should have paid 105 plus 14, but you'll end up paying this whole amount, and there's an extra 147 billion that you're ending up paying for this transaction, which did not make it financially feasible. Now, when we go to acquisition feasibility, we try to understand Amazon's past acquisitions and what kind of acquisitions it looks at. We finally understand that Amazon either goes for early stage companies or it goes for companies that it thinks can expand their business vertically, as we mentioned before. It does not really go for acquisitions which are overvalued and which are high flying, like Netflix in this case. This is based on their past history. Now, we try to look at acquisition from two perspectives. Would acquiring a 51% stake in Netflix make sense? The answer was no. And that was because the shareholding is so fragmented in the company. It will leave a lot of parties to be negotiated with, and the poison pill program would definitely not make it easy for us to do that, which is something the company has initiated in the past when Carl Icahn tried to acquire the company. And also, we see that there are things which are passed by special resolutions in the company, and for that, you need three-fourth majority. So, acquiring just a 51% stake would not give you control over these special resolutions since you don't have the 75% stake. Now, this is something we came up with in our research about the stakes in this industry. Now, looking at a 100% stake, it was not financially possible for Amazon to acquire it 100%. Firstly, because looking at the cash balances of the company, which is 55 billion, and some of it needs to be serviced for current liabilities, there was not enough cash to fund a 267 billion purchase price, which we calculated before. And if we do take debt, the debt would be one of the largest issuances ever, and it would degrade the, the credit rating of Amazon. It will increase its cost of debt and have other implications which are not financially sound for Amazon. And we could also see the future trend in debt issuance. Even if it did try to take debt, there was bound to be a fall in debt issuances during that time because of the presidential elections on the corner. So we also try to see what's going to happen in the market, do some research on that, and try to see where it's headed to back up our analysis. Then there would be now there would be other threats or other hindrances that we've discussed. One would be antitrust. I'm not going to go into the details here, but this would basically mean what are the kind of issues that come up when two large companies in the same industry combine and how it affects the HH index. Then we had other hindrances regarding Amazon and Netflix culture, which is very different from each other. The poison pill program that I talked about, and transfer pricing and accounting hindrances that will come up if the transaction does happen. Lastly, we spoke about some loss of creative freedom that would happen, considering Netflix provides a lot of freedom to its directors, unlike Amazon, which does create its work in a more cost-efficient and I would say large-scale way. Netflix is slightly more extravagant in its expenditure, gives creative freedom, and does not like interfering with the director's way of working. So definitely the two cultures are not very similar, and there would be some obstructions if they do happen, if they do combine. Now we're talking of alternative solutions. If Amazon is not acquiring Netflix, what it should acquire, right? And we had three alternatives. Either Amazon can invest further in its own content library, it could buy out a media company, or it could invest in data analytics. We went ahead with the buying a media company solution, and we've detailed out the reasoning here as well. Now, the three areas that we have considered here is important because it is not very obvious that Amazon should acquire a company. We should also look at other alternatives wherein even if they're not buying a company and is solving the problem, then we should explore that as well. So we did not preempt that buying is the only solution. We looked at other options as well, and then we chose the one which is most appropriate for Amazon. Um, we went ahead with this, and then we looked at a few media companies that are existing. We rated their attractiveness on these metrics and a final verdict. So we have Hulu, we have HBO, we have these firms as well. By the way, if you would have seen the news, Amazon ended up acquiring MGM last year to expand its content library, which is one of the options we had proposed, but we did not go ahead with this. But definitely, it was a feasible transaction that we had looked at, and um, the day that the news came out, it sort of validated that okay, we were on the right lines, and Amazon did end up acquiring MGM and getting all those titles of the James Bond movies and everything under its belt. We looked at Viacom CBS as a target in our solution in 2020. We looked at their business verticals, movies, television, and sports, and how that would be beneficial for Amazon in their content library. We looked at their asset base. As you can see, Viacom CBS has some movie networks like Paramount, some OTT networks, interactive divisions, news and sports divisions, and it basically covers a lot of different verticals and would have been an amazing asset addition to their library. Then we looked at the revenue model as well, by division and by type, and where the revenue comes from. Then we looked at the three cost drivers. What is the programming cost, production costs, and distribution cost? The, the programming costs is a very interesting component in this industry. It's basically amortized over different years. So if you incur say 100 billion in a particular year, you would not write it off in your P&L as 100 billion in one go. You would distribute it over 5 years and write 20 billion and say your costs for that year. So this is something that is amortized, and this is on acquired content here, and this is on original content. So both of these costs are amortized, and this is the case for Netflix as well, not just Viacom. They amortize their costs on content. Now we look at post-acquisition strategy. What would happen if CBS and Amazon are combined? And this was something where we really went out of our way to do things because it wasn't expected in huge detail what the alternative solution would be, but we sort of went ahead with showing what all can be continued, what all can be closed once the two companies combine, how Prime Video Live can be introduced, and it'll include news and sports as well, how Pluto TV, OTT service of Viacom, can be continued, and the other one, Showtime and CBS All Access, can be closed based on the existing popularity that they already have. And then we looked at the different revenues, how they would be impacted after the transaction. And you can see the reasoning here on the slide, what we've written out for each of these revenue types. Lastly, we conducted this analysis. So over here, we basically want to see what would be the subscriptions, the revenue from subscription services post-acquisition, and currently without the acquisition, we definitely saw a bump. And this was something we calculated in our model. And the final waterfall chart is sort of try to understand what are the different revenue types and how they stack up for the final entity. So going from Amazon itself to accounting for Viacom, cable revenue, TV revenue, advertising revenue, content licensing, and coming up with the final entities level. This was something again that was not asked for, but we ended up doing it. I think this is one of the differentiators in our competition, that we basically looked at the financial feasibility of the transaction by conducting a merger model of the two companies, the combined entities, and performing accretion dilution analysis. Would the transaction like improve shareholder wealth, or would it destroy shareholder wealth? So we conducted DCF for the combined entity after conducting a DCF for Viacom CBS. Then we looked at the alternative solution, the purchase price, how Amazon can just take on debt in 3 tranches, and it can pay off its debt. Because Viacom CBS was not so overpriced as Netflix, taking on debt would have been feasible here. And we calculated that how they can repay the debt with the debt amortization schedule over here. Then we performed the performance financial scenario, combined entities expenses, combined entities EBIT, and all those things. Wherein basically we created a model combining the two entities in one entity and conducted that. It obviously required a lot of assumptions because it's not easy to forecast things for a combined entity, but then we detailed out our assumptions in detail in the model, and we went ahead with that. This was the accretion dilution analysis, which we conducted. Again, not going into the details here, but this was something to understand, is there a destruction or in addition to shareholder wealth? And we looked at the current capital structure, the proposed structure, the change. And on the right, you can see what is the intrinsic value per share, Amazon, Viacom, synergies, and performa. So if Amazon is $1,600, we're getting to an $1,887 performa share price based on our analysis of Viacom's intrinsic share price and the synergies that it do. So finally, the conclusion of this solution was understanding that there are not a lot of synergies to be accrued from this transaction between Amazon and Netflix, identifying that Netflix was highly overvalued, seeing that what is the financial feasibility of the first deal, Netflix Amazon, and then the next deal, and zeroing in on an alternative strategy, which is Viacom CBS. All these things together will drive value for Amazon. Now, I'm not going to go into the appendix slides, but I'll definitely go into one of the slides that we made here, which I think helped us win the competition. We were the first Indian team to win this competition and the first undergraduate team to win this competition. What really helped us set a solution apart was a couple of things. I mean, it really varies from team to team, but for us, it was firstly going ahead and refining our valuation skills ahead of the competition because we knew it would be required during the competition. Then we delivered more than what was asked for, as I mentioned before, creating merger models, performing accretion dilution that is not expected to be done in this case. We handled our Q&A well. We knew which person will answer which type of questions, and we were prompt in our responses. Our research was extensive, as you would have seen. For example, we took our time to understand the operating model of the companies, how the backend works for each of the companies, and what the investments already are in this sector, and then a certain synergies. Lastly, I think we did not start off with the intention of winning per se, but we were also passionate about doing well in this competition that we put ourselves in a position to win. And it's not important to feel that from the beginning itself. It's something that if you feel through like midway through the competition towards the end as well, that's good because that gives you that extra push of energy to really go for the win. So I think that is it from my side, and yeah, we can wrap this up.
On, please end the recording.